Hello and welcome to the training video for the XAUUSD 15-minute chart. This is a PTU trend jumper free trade plan we're giving away for a limited time. This video will teach you everything you need to know to trade this trade plan. Hi, this is TJ with netpicks.com and the Premier Trader University Trend Jumper Trading Strategy. I'm sure you're going to love this trade plan. Using Forex to trade gold is a very innovative approach and gives us a lot of flexibility that we would not otherwise have if we were trading gold futures contracts. For one thing, when we're trading Forex, we have the ability to tailor our position size according to the amount of capital we have available. At the Premier Trader University, we always teach that you should never put more than 2% of your capital at risk on any given trade. So for those with small accounts, you might find yourself trading gold contracts with too much risk because a contract can only go so small. This is a Forex pair that puts the gold versus the US dollar, so it treats gold as a currency. And since it's a Forex pair, we're able to use a combination of micros, minis, or full-size lots depending on how much capital we have available to trade. This allows traders with small accounts to steadily build their account up, and as your account grows, so does the 2% level of risk that you put on each trade, and thus you can grow your account steadily and surely. Moreover, this Forex pair really swings well and trades well. There's really great movement, and for that reason it works with the trend jumper beautifully. So let's jump right into the training. The first thing I'd like to do is introduce you to the indicators. You'll notice that there are 3 lines on this chart, 2 jump lines, and an EMA, an exponential moving average. The exponential moving average is set to 23. You don't have to display it on your chart, but I like to see it personally. We use it as a filter. Any trade that sets up against the direction of the EMA is going to be filtered out and is a trade we're not going to take. Now, what creates a trade? Well, it's very similar to the free plan that we've given away for the Aussie-US 15-minute chart and for the Euro-US end-of-day chart. You have a confirmation line that crosses over a jump line. Okay? So in this case, and what's unique about this plan, is that the slower line in cyan is actually the confirmation line, and the faster line we're using as the jump line. This is reverse to how we typically trade the trend jumper, but it's also what has made this a really great trading chart. So when you see the blue line, the cyan line, come from above and then cross below, I know this looks kind of strange because it's actually higher, but you'll notice it's underneath the red dotted line. It comes from above the red dotted line, gets stuck on the red dotted line, and then crosses below the red dotted line. Okay, the first red bar that closes, once that happens, is a setup bar. Okay, and it's a setup bar to go short. And the way we know it's a setup bar to go short is because the trade is beneath the bar. When you see a setup that's below the bar, you're always going to go short. Okay, the plus sign, that's your entry. There are 3 targets, target 1, target 2, and target 3, which is quite a bit lower. You'll notice over here on the smaller trade, target 3 is down here. The trades are adjusting to market conditions, so every trade is going to be a different size depending on the conditions at the moment of the trade setup, just like any other trend jumper trade. Okay? Now for a long trade, it's the total opposite. The cyan line has to come from below the red dotted line, cross over, and close above the red dotted line, like right here. So that would be a long setup. By merely clicking on the bar, like this one, you get the entire trade in the data window. It tells you the entry, your targets, and your stop. This trade plan is designed to be traded with 3 positions. But you can trade it with 1 or 2 positions if you'd like. But the beauty of Forex is the ability to, like I said earlier, tailor your position size. So you can put on small positions so that you can trade 3, for example. You're going to take position 1 off at the second target. you're going to take position 2 off at the third target. Let's just see where that is. Way down here. Quite often it's not going to get to that target, but you'd be surprised. Sometimes it does, which leads me to the third position. The third position, we're going to actually trail this red dotted line, and I'll talk about that in a little while. If for some reason you cannot get all the way to that third target and the price comes up and closes above that red dotted line, you close out your remaining positions and the trade is over. Okay? Now when you downloaded this, you also received a PDF file with all the trade details. So you're going to want to follow that plan. And it explains in greater detail when we activate the trailing stop and all the other maneuvers that we're going to do. But I'll quickly summarize it here. When you hit the first target and the price has gone at least 18 pips, then we can lock in a little bit of profit. In fact, we're going to lock in 9 pips. Okay? If we were in this trade here and it hit the first target and it had not gone the full 18 pips, then we cannot lock in 9 pips. But once it has gone to that first target and moved down below it and finally has hit 18 pips, then you can lock in 9 pips. Okay? So trade management rule 1 is it has to hit the first target and go 18 pips, and then you could lock in 9 pips of profit by moving your stop from here down 9 pips from your entry. Okay? The second trade management rule is when we activate the red dotted line as our trailing indicator. This is a little bit tricky, but you can do this manually. It's very simple, and this is described in the PDF file. But it has to go 135% of the distance from the entry to target 1. All right, so you calculate what the distance is between the entry and target 1, multiply it by 135%, and then take that number and subtract that from your entry for shorts or add it to your entry for longs. And when the price hits that level, you then begin trailing the red dotted line. And you do that with the trend jumper technique, which typically says for every bar that closes below the red dotted line, you look at the reading, 1296.9 for example. You could either round that extra digit or not. It's optional. And then you place your stop 2 pips above. So that would be 1297.1, right? Each pip is the decimal, one digit over to the right of the decimal. The second digit is 1/10 of a pip. Okay, so it's really simple and it's really straightforward, and I've pretty much taught you, 95 or 99% of this entire strategy already. The other thing that you have to bear in mind are the rules of the trade plan. Okay? One of the main rules, of course, is your start time. This trade plan begins at 7 a.m. Eastern. You wait for a fresh setup. In some trade plans, we're able to get in sync with an earlier trade if it qualifies, but not with this one. With this trade plan, we're not going to get in sync with earlier trades. We're going to wait for a brand new setup beginning at 7 a.m. Eastern, and we're going to take trades up until 12:30 p.m. Eastern. And we're not going to take any trades after. If we're still in a live trade, we will hold it and just let it play out for as long as it takes. We also use what's called a power of quitting 1 strategy, which means we get 1 winner and we're finished. In fact, there's actually 2 ways you can do this. One is you trade it for 1 trade a day and that's it. Win or lose, 1 trade, that's it. So it's a very simple trade plan. A little bit more elaborate approach that you can use is what we call a power of quitting 2. So you have to get 2 winners and be positive. However, if you're going to do that, after 1 loser you quit and you only take 2 trades total. So what that means is if the first trade is a loser, you're done. If the first trade is a winner, you can take a second trade. So win or lose, you're going to be done. All right? So 2 approaches, either one trade or two trades. That's it. And they're both quite good. I think long term, two trades probably has the better results. But if you just want to do one trade a day, you're going to do just fine. All right, so let's look through some examples. So remember I said we start at 7 a.m. Well, we already saw this trade, but let's take a look at it. This one was a great winner, wasn't it? This trade plan will most likely work during other time periods like the European session or the Asian session. But I don't want you to trade during those times unless you fully back-tested on your own and proved yourself that it works. Okay? This has only been tested for the US session, and it actually begins quite early, 7 a.m. Eastern. So when we look at this trade, that's at 4 a.m. So we're not interested in that. In fact, the next trade actually comes during our trade time, which is right here at 9:30. And you can see it's an easy short trade. You click on it, you get short at $12.99, either 0.55 or you round it down further away, $12.99.5. Okay? But you could trade it with that tenth of a pip quote, right? Those are executionable numbers. So you could definitely fine tune it and get it exactly to what is showing on the data window, $12.99.55. You're going to exit the first position when it gets down to that second target of $12.92.47. Okay, and that's a nice trade, right? It's over 70 pips. Over 70 pips. While it's moving down, remember when it hits that first target and it's gone 18 pips, you're going to move your stop down from here. You're going to move it down to lock in 9 pips. I recommend that you wait until after the bar closes. Okay, so that's going to go from $12.99 minus 9 pips down to $12.98.45. Right about there. Okay, but what could happen is it comes down and then it moves around. Now remember, you're not going to move this stop down until the price has already hit the first target, has gone 18 pips, and I would even wait for the bar to close and then move your stop. Okay? Meanwhile, once it's gone 135% of the way from the entry to target 1, you start trailing the jump line, and that's based on a closing basis. And remember, each bar that closes below the jump line, you would then wait for the close, take the reading, and then put your stop 2 pips above it. So in this case, it would go to 1297.09. And you can use a horizontal line like this to place your stop visually, or you can just put it into your order entry platform with whichever broker you're trading with. Okay? Of course, you're going to take part of your position off here, and you'll see that the last bar to close below was this bar. And so we're going to put our stop at 1296.35, right? 2 pips higher. So 1296.35, right around there. And notice that when it comes up, notice that it closes below the jump line again here. Remember, it's based on the last bar to close below the jump line. And how do we know it closed below the jump line? Well, by clicking on the bar, you could see the close is at 1293.46 and the jump line's at 1293.52. So it closed below the jump line. So now you're going to move your stop around this jump line number. So you're going to move your stop to 1293.72. And that locks in quite a bit of profit from here down to here, doesn't it? And when it comes back up, you're going to be out of the trade with the rest of your position. And so that's a pretty profitable trade. Remember, the objective is not necessarily to hit our full targets all the time. The objective is to get the most out of these moves and to trade to make money. Okay? And quite often, we're not going to hit our full target, but we're still going to make a very profitable trade. So keep that in mind, and don't be discouraged if you take partial profits on a lot of trades that don't ultimately hit their targets. All right, we've got really big targets in order to hit the home run trade, but also in order to go as far as we can in that direction of the target using our trailer. So that's an important concept. Let's go to the next session. All right, so 7 a.m. right here, and you can see there's a setup, 6:45. Can we take that trade? Well, we can't, right? Because we're not getting in sync. If we were to get in sync, then at 7, we would take the trade. But we want a setup that begins at 7, okay? That would end up losing, wouldn't it? So then we have a long trade, and the long trade triggers in, and it does stop out. All right, so we're done for the day. Remember what I said? After one loss, done. So that's a loser. And you know what? You could see that the trade itself was a pretty darn good idea, wasn't it? I mean, look what ends up happening. Zooms past the targets and keeps on going. The only problem is sometimes markets are noisy and they don't do everything according to plan. This one stops out. We don't know what's going to happen at this point in time. We just have to trade our plan and realize that it's the edge that the strategy gives us over time is how we make our money. So we want to remain disciplined. Let's go to the next session. And the next session was yesterday. All right, so yesterday, remember, 7 a.m. And look, this bar does close at 7 a.m. and it gives us a setup. So right at our start time, we're able to take this trade. It triggers in, comes down. It doesn't hit the first target yet, so we're not locking in our 9 pips. And we also have to make sure that it's gone 18 pips. All right. So why does this say plus 2.3? Which is 2.3 is 23 pips, by the way. The reason why is because that's where the trailer stopped out. Okay? So what happens is it comes down and it hits this target here for 40 pips. And that's the last bar to close below the jump line. So we have to put our stop 2 pips above at 1288.52. We're going to put it at 1288.72. And so it made 23 pips per position. It actually made more than 23 pips, right? It made 46 pips. So this was a really big session. Actually, 63 pips total. 63 pips with 2 positions. With 3 positions, you add another 23 pips. So 86 pips on this session with 3, right? So you're done, unless you're doing power of quitting 2. If you're doing power of quitting 2, you take one more trade, and that one's going to trigger in, and it's going to stop out, and then you're done. Remember, power of quitting 1 could be the way to go for you, but I think in the long run, power of quitting 2 probably gives you better results. But that means sometimes you're going to give back some profit. Okay, let's take a look at the next session. Actually, it's today, May 1st. This is the day I'm recording this. So we have a setup here. It's at 2:30. You'll notice that there have been some really good setups during the European session. Okay, and you'll find this probably works really well, like I said. So for European traders, take this plan, test it out. But for this trade plan, we're waiting for our first trade. We get a setup here at 7:15. It does trigger in 2 bars later, and it spikes down when there's a news release. 42 pips on the full target, and then of course we stop out with a 9 pip profit. Remember, we're locking in 9 pips. We're locking in 9 pips. The last bar to close below the jump line was this one. So if we're trailing the jump line, the stop is actually a losing trade. So we've protected ourselves by locking in our 9 pips. And so we get 18 additional pips, right? 9 per position. And so a total of 60 pips on this trade. And again, if you're taking a second trade, that trade ends up losing. All right, those are the last 3 sessions. Let's just look at a few more, and I think we'll be done with this training. All right, so I just randomly pushed the clock back. This is October of 2013, quite some time ago. Let's just scroll through and look at some trades. One thing I want to point out is how the filter works. If there's a setup that is against the direction of the filter, it's not going to show up as a trade. Okay? As soon as I see one, I'll point it out to you. Well, actually, here's one right here. Notice how the cyan line crosses from below to above. Well, that should be a trade. Remember, it's the first green bar once the crossover occurs. And it could be on the same bar. In other words, it crossed over on this bar on a closing basis, and we had a green bar. So that's a legitimate setup. But the filter prevented us from taking it because it's against the direction of the EMA, the 23 EMA. Unfortunately, because it would have been a winning trade. Filters are not perfect. Sometimes they're going to filter out winning trades. But it makes a big difference because it filters out a lot of losing trades too. Now let's talk about when a trade is canceled. Well, first of all, let's just look at the first trade of this day. Here it is at 8:30. And that's a news release. So you might want to wait a little bit when news comes out. If it's a news release, make sure your spreads are not too wide. One of the things with Forex is you have to be careful. If the spread is too wide, you may not be able to take that trade. You have to let it go. But sometimes the price is going to move around a lot. I mean, if you look at a 1 or 2 or 5 minute bar, it's going to be able to get you in that trade. So you just got to pay attention, watch your spreads. As soon as they normalize, you can take the trade. And of course, you can see that's a pretty nice winner. I want to find a canceled trade. All right, here's a canceled trade. Notice that it crosses over here from above to below, and then you get the first red bar. Okay, now why is it canceled? Because before it triggers in, the confirmation line closes on the other side of the jump line. Okay, this should be a concept that you understand because of the other free strategies that we've given away. It's the exact same approach. Once the confirmation line closes on the other side of the jump line, the trade is canceled. Very important. It's not enough for it to merely close on the jump line, like on this bar. Actually, on this bar, it was still below. You have to look at the data window because sometimes it's too close to tell. But if it closes on the jump line, that doesn't cancel the trade. It has to close on the other side of the jump line. Okay? So if you're going with this trade and you're going with power of quitting 2, you might say, well, there's your next trade, but look at the time, 13:30. That's after our stop time. We can't take the trade. Let's go to the next session. All right, so first trade at 7 a.m. Well, this one's at 6 a.m. Can you take the trade? Well, no, because we do not get in sync. You may decide, hey, wait a minute, those are good setups. I want to get in sync. And if you get in sync, that means that the trade happened earlier. It hasn't canceled. It has not yet hit its money management level. It has not yet hit its stop. So you're going to take that trade anyway. You know, a lot of times those trades are going to work out. But what I've learned, the long-term results are better if you wait for a fresh setup. So let's just call this getting in sync idea optional. You could test it out for yourself. You may decide you want to do it. Now, these are typically good setups. So just following the trade plan, we're just waiting for a setup, and we get one here. Comes at 10. And does it stop out? Well, the stop is at 1282.62. It stabs down to 1282.58. So unfortunately, it does. Here's a case where the rule of not getting in sync prevents us from taking a winning trade, and the first trade we get is actually a losing trade. You know, nothing's perfect. And also, the second trade, remember you quit after one loss, that's a nice winner also. The thing to keep in mind is we're looking at the long-term statistical edge that the trade plan gives us. Nothing's going to be perfect. You may decide to take these trades and cheat the plan, but then what are you going to do next time? Ultimately, it's going to catch up to you. So you're better off just sticking with the plan and staying disciplined. So what's the next trade? Well, right here, 7:30. Triggers in, stops down here. Do you have a stop and reverse? You do. When I have a stop and reverse like this, you have two choices. You could either take it or you could ignore it. And sometimes you're going to wish you took it, and sometimes you're going to wish you ignored it. The trade plan would have you move your stop from the original place up to the entry of the new trade like that, and you would literally stop out with a loss. So this trade would be done. If you want to trade the trade plan, That's how it works. But hopefully you're seeing that this trade plan is very versatile. You've got a winning trade here at 3:45 a.m. You have a little additional setup here, which is a quick little winner. The trade we want to take ends up with this stop and reverse, which is unfortunate because you can see the trade would have been a winner. So you guys might decide to trade it differently. Look at this one, another great winner. Lots of winners, even that one's a winner too. So I've presented a way for you to trade this that's very tight, very concise, but is by no means the only way. I mean, you can see there are really good trade setups everywhere you look. So this one, 7 a.m., you can see it's at 7:30, triggers in, comes down, doesn't hit money management yet. Well, actually it does. Hits money management. Has it gone 18 pips? It has. So it's going to pull up and stop out with only a 9 pip gain. You're done. How about this setup? This setup triggers in. Believe it or not, the stop actually holds. It zooms up, hits target 2, and if you're trailing the jump line, it's not going to stop out yet because you're trailing, you're locking in your 9 pips only. It's the last bar to close above the jump line. So once this bar closes, then you're moving your stop up. Okay? And you keep moving it up, keep moving it up. Stops out right up in here. 2 pips below the jump line. Almost gets to that third target. If you're going for a second trade, you can see that one ends up probably being a partial winner, getting you 9 pips. You'd have to see if it went far enough. All right, let's look at one more example. Here we are at 7 a.m. Get a short trade, comes down. And again, it's 18 pips. You're going to lock in your 9 pips of profit, and you're done with the trade. All right, that's it. Hope you enjoyed this training video. I think you're going to love this strategy. If you're going to deviate from the trade plan, my best advice is that you test it. Use a spreadsheet and log a bunch of trades. You're trying to get a long-term winning edge that the trade plan gives you over time. Okay, don't be fooled by a few sessions here, a few sessions there, a trade that would have won had you not done this rule, and vice versa. It's all about how it performs over a long period of time. This trade plan has been tested since, for well over 2 years, and it does give you a great edge the way I'm presenting it, but again, it's not the only way to trade it. You'll see how versatile the trend jumper can be, trading gold versus the dollar in this fashion with the 15-minute chart. All right, well, thank you very much for joining me on this training video. This is TJ with the PTU Trend Jumper Trading Strategy. I will see you on the next video.